Hello traders, Bash the Trader here. So in this video, I'm going to be talking about how to use the Fibonacci retracement tool in Forex. That is, how to use the Fibonacci retracement tool the right way, right? How to use this Fibonacci retracement tool to catch sniper entries, basically to take your entries in the market, right? Basically, you need to know when to buy and sell, right? That's what you as a trader are looking for. You are looking to know when to buy and sell. So basically, with the Fibonacci retracement tool, you are able to take your entries. You're able to know where your take profit level is going to be. You're able to know where your targets are going to be, right? So those are some of the things we're going to be looking at in this video. So right here on my screen, I have the Fibonacci tool here. So if you are a new trader and you don't know what the Fibonacci retracement tool is, right? So the Fibonacci retracement tool is basically used to measure price retracement level in the market, right? So the imbalances between the supply and demand of price, right? So basically the Fibonacci has different levels, right? And these levels are represented in percentage or decimal. So mine is in percentage, as you can see here. So you can see we have the 0%, we have the 50%, we have the 61.8%, we have the 78.6%, then the 100%. So basically, the numbers are represented in percentage. So now, these numbers are basically used to um, predict price future movement. That is, you're able to know where price is going to be heading, right? Based on these number that we have on the Fibonacci retracement tool, right? Basically, it's just support and resistance levels on the Fibonacci, right? Basically, price levels that we tend to see reversal in price movement, right? We tend to see a change in character. So let's begin to understand how the Fibonacci works. So I'm going to be using this pound Aussie as a case study because I took a sniper entry on the pound Aussie dollar yesterday during the New York, was it the New York or during the London session, right? So I took a sniper entry on pound Aussie dollar plus 100 pips entry right there. So I'm gonna explain what I saw and why I took the trade. So let's look at it now. So real quick, let me delete this. So let's go to the 15 minutes. Let's go to the 15 minutes. So I'm just gonna rewind this back in time. So let's look at these now. Okay, good. Now, so for the Fibonacci, you this is how to draw the Fibonacci. You take it from your 100% to 0%. That is, if you are buying, if you're looking to buy, you take it from 100% to 0%. Then if you are looking to sell, right, you take it from 100% to 0% as well, but from the top to the bottom. Now you can see the difference, right? You can see how these diagonal line is facing down, right? You can see, and this is facing up. So because you're selling, it's meant to face down, and your buying is meant to what, face up. Because most people don't know how to draw the Fibonacci. Most people just they just draw the Fibonacci like this and then think that, oh, they can use the Fibonacci to buy and sell in this manner. No, this is very wrong. You don't do this. This is how to draw the Fibonacci. So you ask yourself, you want to buy an asset, you want to buy a currency, then you grab it from the bottom, right, to the top. You stop there, right? I'm going to explain those points that you are drawing the Fibonacci on very soon, but this is the right way to draw the Fibonacci. And if you are selling, you take it from where? From the top to what? To the bottom. That's it. So now let's look at those points. What is this 100%? What is this 0%? Right? So basically, when it comes to the Fibonacci, you're looking for your swing high and your swing low. So I'm going to pull up a text. So let's say swing high, then swing low, right? Swing high, swing low, right? That's what you're looking for when it comes to the Fibonacci, right? The 100% and the 0%. You're looking for what? A swing high and a swing low. That is, you're looking for what? An impulsive move, right? Either to the upside or to the downside. If you are buying, you're looking for an impulsive move to the what? To the upside. You're looking for a rally. to the upside. You're looking for a demand, a very strong demand to the upside, right? And then you wait for the retracement to happen, and then you take your entry right there. So that's what this video is all about. It's talking about the entry levels, right? The entry levels when you are using the Fibonacci. So now we talked about the swing high, the swing low. Those are the points you're looking for. That's the first thing you're looking for when it comes to what using the Fibonacci. You identify a very good swing high and a swing low. So that's the first thing you're looking for. And I said in terms of buying, you're looking for what? A demand. You're looking for a strong rally. That is an impulsive move to the upside. So let's look at this. So basically, this is what you're looking for. You're looking for a rally, right? And then you're waiting for the retracement level to happen right here. You wait for the retracement level and then you enter and take your entry and wait for your target, right? So that's basically what the Fibonacci is being used for. So you wait for your impulse to happen. Once you identify the impulse, that is, you then identify the swing low and the swing high of that impulse. So this is the swing high and this is the swing low of the impulse. So after identifying the swing high, the swing low of the impulse, you wait for the price retracement level, right? You wait for the price retracement level and then you take your entry from there. So let's look at that now. So I'm going to draw the Fibonacci on this arrow here. So once I draw the Fibonacci like this, from where? From 100% to 0% right here, as you can see on the screen. So then you wait for your retracement level. So now, what are these points for? What are these percentage level, price level? What is it for, right? This percentage level that you're seeing on the Fibonacci. So let's talk about them. So I'm going to put up a text real quick. We have the 50%. We have the 61.8%, right? Then we got the 78.6%. So these three levels, what are these numbers? What are these numbers? What are these price levels? So basically, when it comes to the Fibonacci, there's a standard convention that we have golden ratio, right? Golden ratio on the Fibonacci, and these are the golden ratio on the Fibonacci. These three percentage level you're saying here, these are the golden ratio, right? And basically, these are what the big banks and institutions are using, right? These are price levels that the institutions have huge orders sitting in that level, and then they come back to pick up the orders, and then they continue to travel to their destination. So basically, when it comes to forex or trading any commodity or asset, basically price is moving from point A to point B. That is, price is traveling for, let's say you're traveling from Los Angeles to, to New York, right? You know that you cannot travel all the way to New York uh just like that. You gotta stop at somewhere. You gotta rest, right? You gotta stop at an hotel, to try to recharge yourself, or try to fuel your car so that you can continue your journey. So basically, these are what the retracement level are for in forex, right? So as you can see, point A. So let me just say this is point A and this is point B. So let's assume that this is Los Angeles here and this is New York. So you are traveling from Los Angeles to New York, right? You gotta no, this is not the destination. So let's say this is the destination here, right? Let's say this is the destination here, right? So if you are traveling from Los Angeles to New York, you have to stop at, maybe, I don't know, maybe you have to stop at what's it called, Arizona, or you got to stop somewhere and then refuel your car to continue your journey, because the driving force of the market is basically supply and demand, and which requires what? Energy, right? So it's the same thing in real life. You require energy in order for your car to move, right? You require energy in order for you to go from one point to another. So this price retracement level that you see here, these 50%, is 1.8%, 78.6. These are what we call the golden ratio in the market, right? So I'm going to pull up the text and say golden ratio. That is, these are points or areas where a reversal is meant to happen. right? That is a change from supply to demand, right? A change from supply to demand. Take note of that. Where reversal is meant to happen, price reversal. So if an asset or if a currency was selling, when it gets to the golden ratio, there is always a form of reaction. That is, be expecting that price is going to reverse. If price was selling, which is supply, if there is supply at that point in time, when it gets to the golden ratio, there is going to be what? A change from supply to what? To demand. You understand? Retracement, right? That's why we call it the retracement level. So let's look at a case study now. So which is what I talked about. This the pound Aussie dollar. This was an entry that I took on the pound Aussie dollar yesterday. So let's draw the Fibonacci here now. So I'm gonna reduce this. Actually, let me delete this. Okay, good. And also this. Good. Nice. So what's the first thing I'm looking for? Identify an impulse, right? An impulse. Then I take my Fibonacci from the low of that move, right? The swing low of that impulse, right? And draw it all the way from 100% to 0%, right? To the end of the impulse, right? At that point in time. Keep in mind, at that point in time, right? Now, all I got to do is identify where I'm going to take my entry. And I said that the golden ratio is where the big banks and institutions, who are the major participants of this market in Forex, right? In crypto, who are the major participants? The big banks, the governments, the hedge fund companies, the big investment companies in the world. Those are the major participants of the market, and they are the what? The market movers, right? They are the what? The market movers. These are the guys that are actively moving these markets. You as a retail trader, with probably the maximum a retail trader can have in his or her accounts is like 100,000 USD, right? That's more compared to what these big banks and institutions have in this market. They are operating millions of dollars, billions of dollars, trillions of dollars, right? So what's your money compared to them? It's just like an ant trying to fight an elephant. You understand? He can't win the battle, right? He can't survive. The elephant is going to step on the hand. That's the same thing with this market. So take yourself as an ant in the market, because your money is small compared to what the big banks have. You are operating maximum, let's say a retail trader can have 100,000 USD, right? You have 100,000 USD in your portfolio. You're trading an 100,000 USD account, right? But you know that the other big players in the market, they have more than you. They have millions of dollars. They are trading trillions of dollars that are being executed in seconds, in minutes. High frequency forex, high frequency trading, right? So who are you compared to the big banks, right? So now basically what you're doing in this is that you're following the footprints of the big banks and institutions, right? And where do they take their entry from? They look for retracement level, right? They look for a drop in price, and then they continue their journey. You understand? So what are those levels? The 50%, the 61.8%, the 786%. All you gotta do is just wait for the price to get to any of those your levels, and then you take your entry. So basically, I prefer the 61.8% because I like much more deeper retracement price level, right? So the 61.8%, I love it a lot because it's an entry price level that is good, where you can take your entry from, and then you benefit from a very good move. So let's look at how I took my entry here now. So the 61.8% or the 786%. So let's look at what price does. So all you got to do is wait for the reaction, right? You wait for the reaction to happen, right? So this is what we're expecting. We have identified the impulsive move. All we are waiting for is what? Is the retracement to happen. And after the retracement happens, then you wait for the what? The continuation of that move. So basically what the Fibonacci is used for is basically for what? Knowing when to enter, and then knowing if price is going to continue or not. You understand? Basically, you are predicting, knowing when knowing what is going to happen in the future. That's just what the Fibonacci is. So Let's delete this. Gotta delete that. Now let's wait for our reaction. So I'm gonna play this now. So let me play these. That's too fast. Let me reduce the speed, and then let's fast forward. Boom, boom, boom. As you guys can see, actually no, that's not where I took my entry. No, that's not where I took my entry from. This is where I took my entry from. So yeah, this is where I took my entry from here. So I'm gonna rewind this back now. Sorry, this is where I took my entry from here. Where is the Fibonacci? So I'm gonna draw it. So I took my entry from here like this. Yeah, that's where I took my entry from, and I stop here. Yes, good. So let me rewind this now. Nice. Oh wait, let me go. Let me play. I'm trying to remember where I took my entry from. It's a lot of candlesticks here, so I gotta find where I took my entry from. So let me just fast forward so that I can see where I took my entry from. Okay, that's right. That's right. That's where I took my entry from. Good. I just gotta confirm that that's where my entry was taken from, right? So this was the retracement. Let me rewind this now. So this was the impulsive move rather that I identified, right? This impulsive move. So if you go on the 5 minutes, you're able to see the candles very well, or you can even go 1 minute to see, yeah, that is a rally, right? To see that is a rally. So you can see, yeah, 7 minutes, you can see, yeah, that is a very good rally. Let me increase the so you guys can see the candlestick very well. So you can see that this is a very huge impulse that occurred on the 7 minute time frame, right? Very huge impulse to the upside, right? All we are waiting for is what this the stopping point of that impulse, right? So look what happened, right? You see the price started to sell, right? Supply taking over right there. You can see supply taking over right there. Then we fast forward. So let's fast forward. Boom. You see what's happening? We're still waiting, right? We're waiting. That's why I said I like the 50% level. If you guys see what the price, I like the 61.8 or the 786 level, like deeper retracement, right? So if you guys see what happened here on the 50%, there was a tiny bit of reaction, I think. So let me go back here and see. Just to fake out some people and then go deeper, because some people have their stop losses placed here, right? So let's see what happens here. So yeah, you see that there was a very slight very close to the 50% reaction, but I'm not gonna take my entry there, right? You are not gonna take your entry. You gotta wait. The best move are always coming from the 61.8%, right? Or the 786%, right? Or even lower, yeah, right? Close to the 100%.